We approach this through our strategy's 5-phase framework. We are not reacting to headlines. We are tracking signals and how stress moves through the system. When gold moves like this while other hedges stall, something shifts. Not a crash call yet. More like the system quietly repricing trust. This matters now because regimes do not announce themselves. They show up as small breaks in behavior. Gold can be one of the first places that shows it. The source argues gold and silver are signaling a loss of policy credibility. He ties that to a weaker dollar and eventual bond market stress. We are translating that view into process, not certainty. Direction is clear. Gold is rising while confidence in fiat narratives softens. This is happening because trust in future purchasing power is being questioned. When that happens, it usually leads investors to seek monetary hedges first. What changes is not today's price. What changes is how correlations can behave under stress. That is where portfolios tend to break. Long yield staying firm, despite easier policy, is not noise. This is happening because lenders demand compensation for time and inflation risk. When that happens, it usually pressures long-duration assets. Crises do not start in headlines. They start when funding stops behaving smoothly. That is why plumbing always matters more than speeches. This is happening because big systems rely on cheap, reliable funding. When that funding tightens, something is forced to sell. Gold often moves before that selling appears elsewhere. The first pressure usually shows up in leveraged and crowded exposures. Then, in duration-sensitive valuations. Labor and consumers come much later if credit tightens. We do not escalate without confirmation. Credit spreads, funding stress, and market breadth tell us if this grows. Until then, this is a warning flare, not a verdict. If this kind of signal-based breakdown helps you think more clearly about markets, subscribing helps you stay oriented as conditions change. It is less about predictions and more about knowing what to watch next. Quick note, this is educational macro analysis only, not financial advice. We focus on probabilities and process. Near term, we raise Phase 2 odds modestly. That reflects compression and rotation risk, not collapse. Phase 3 needs credit confirmation. We are not timing a crash. We are not reacting to one price move. Discipline matters more than conviction here. Gold may be speaking first. Credit decides whether the system listens. Our strategy stays patient until the signal is undeniable.